No big swings for the markets today in North America. Our next guest says the key question for the markets this year is whether central banks have completed their rate cuts. Let's go to John Wilson, co-CEO, managing partner, senior portfolio manager, Ninepoint Partners. Thanks for joining us today.
Thanks for having me.
Okay, so big picture for a moment. How do you see the economy shaping up this year in the U.S. versus Canada?
So the U.S. economy has actually been quite strong, right? We had pretty decent productivity growth in the back half of last year, especially the fourth quarter. So most people see good growth from the U.S. this year. Labor market has hung in well. We just had jobless claims pretty much as good as they get, under 200,000. So yeah, the U.S. economy looks strong, subject to whatever Trump might do over the course of 2026. But as of right now, it looks great. Canada actually also has held in better than people thought when the tariffs were first announced. Now, partially that's because we negotiated, some relief from that. But overall, the Canadian economy has been okay as well. Not as good as the U.S., but okay.
Okay, let's discuss where you see some opportunities for the year. Precious metals is one. What could give it another run this year?
Well, it's obviously been a great trade. We think that can continue. You have developed economies around the world all using fiscal stimulus, growing fiscal deficits. Central banks continue to add to their reserves with gold and de-emphasize the U.S. dollar. So all of that, is good for the gold sector. From a producer standpoint, obviously, there is a big margin now between the price of the bullion they produce and where their all-in costs are, and we think that's a great opportunity as well.
Okay, so are there one or two names you like in the space?
Yeah, of course. There's a number of names. I'd highlight Kinross. We think it's a low-risk way to play the sector. It's got producing properties in the U.S. that are running all-in sustaining costs anywhere from $1,500 to $1,700 an ounce. With gold at over $4,500 an ounce, that's a great spread. So it's a really low-risk, good producer. We think that's a great way to play the price of gold.
Okay. You also like natural gas for this year, which hasn't really enjoyed the same energy that energy sector has had because of AI build-out. What do you see there? Yeah,
this is more of a buy the dip kind of idea. Natural gas was at $4.50 an MCF back at the start of December of last year, so just a month and a half ago. It's at $3 now, so it's come down pretty much 30%. We think the marginal cost of production is around $4 an MCF, so you're not going to get a lot of supply growth here. But LNG is really continuing to come online in the U.S. and Canada, and that's going to grow demand by about 3 BCF a day. So there's a lot of demand growth, not going to be supply growth. The sector, has sold off the price of gas, and that's really because we've had a warm start to the winter throughout much of North America. So we think it can get back above $4, and there's some really interesting opportunities given where the price is.
Okay, let's talk about those opportunities. What do you like?
Yeah, we like Expand Energy. It's a U.S. producer. It's actually the largest producer of natural gas in North America. EXE is the ticker in the U.S. What we like about them, at their current production, they have 20 years of inventory. Their production is close to key sources of demand, whether that's LNG in Texas or the data centers in New York. And at $4 an MCF, you're looking at a 14% free cash flow yield. So, it's an opportunity to pick up a great name with great inventory after it's been hit pretty hard.
Okay, let's get to another space you like, and that is power, but more power generation. Walk us through your idea here.
Yeah, so power, people have been on this theme, obviously, with the whole data center, idea. We love, across the value chain in power, whether that's generation, distribution, backup, all of those areas. But one of the more interesting names we think is Rolls-Royce. And this isn't the car company. That split happened back in the 70s. Rolls-Royce, when it's a UK company, trades as an ADR in the US. They are basically half jet engines for wide-body jets, and the other half is split pretty evenly between defense and power generation. Their power business grew 25% last year. They also actually are an early leader in small modular nuclear reactors. So the UK has chosen them as the technology provider for 3 of those reactors. Czechoslovakia has them on the short list for 6, and they were recently added in Sweden as well. So pretty interesting name, growing earnings in the mid to high teens. We think there's some upside surprise possible there, and these types of contracts are really long-term contracts, so some good visibility.
Okay, we got to leave it there, but I appreciate you joining us. John Wilson, co-CEO and managing partner at Ninepoint Partners.